Welcome to BloombergQuint. There's been a lot of investor interest on the affordable housing space, especially after government's initiative, be it Housing for All by 2022, the Pradhan Mantri Awas Yojana, or the grant of infrastructure status to affordable housing. And what better way to play that theme than affordable housing financiers? And to join us on this discussion, we have here with us Mr. Krishnan Sitaraman, Senior Director at CRISIL Ratings. Thank you so much for joining us.
Thank you, Shraddha, for having me.
Clearly, there's this new wave of interest that we are seeing in the affordable housing space, but there are barely any listed companies which cater to pure play affordable housing segment, and that could mean a loan ticket size of less than about 10 to 15 lakhs. So in your research, have you really found that the government measures have actually translated into numbers for affordable housing finance players? I mean, what are you all picking up?
So if you see the affordable housing segment as such, and CRISIL categorizes affordable housing loans as those up to a ticket size or loan size of 15 lakhs. Now, this is the segment which has registered the sharpest growth over the last 2 to 3 years. So whereas we see the overall housing finance market going at around 17 to 18%, this particular segment is growing in the region of around 40 to 50%. So there is a very sharp growth in affordable housing finance, and a large part of it is catalyzed by these measures that you talked about, the regulatory and government initiatives to promote affordable housing. That is what is driving these growth. So yes, the players in this affordable housing finance segment have been benefited by these governmental measures, and also their growth is a result of the fact that the demand for homes in that category is much higher than the demand for homes at about 1 crore and above level. So if you look at India as a whole, there is a housing shortage, and a predominant part of Indians want to buy houses to live in them, and they want to buy houses which are in that range, less than 15 lakhs or so, and hence there is a demand for such homes, and that is also playing a role in the numbers and volumes at these pure play affordable housing finance players, their volumes going up, and they're increasingly taking up a larger stake in the overall housing finance space.
Okay, in this, given that it's a huge market opportunity and given the competitive scenario, what do you think will make affordable housing financiers really stand out from each other? I mean, what will really drive outperformance?
So at the end of the day, the affordable housing finance players have to be sustainable in the long run, and the way they can do that is by ensuring that their own house is in order. So for instance, if you look at the credit assessment processes, that should be of a very high quality. The underwriting standards, the kind of loans that they will actually take on their books, that should be good. Their risk management processes should be good, and also the human resources which they will be having, that should be of a very high order, which will help them put in place good operational processes, which when married to a good technology backbone if they have in place, that will help them ensure that they are not susceptible to frauds or NPAs or delinquencies going forward, and once that is in place, the volumes that they can generate will typically be adding on to their profitability. So over a period of time, they will register profitable growth and not fall prey to frauds and NPAs, and that is a measure of success of these players. So have their own house in order, have good processes, good people, and the market demand will take care of itself.
All right. Have you gathered any insights on how the borrower profile and credit culture of an affordable housing finance customer differs from that of a traditional home loan customer?
Yes, there are some very key differences between these two customer segments. And the affordable housing segment, what we have seen is the proportion of salaried employees is lower. So in the conventional housing segment, we have around 80% of borrowers are salaried employees, whereas in this case, around what we see is around 60% of people are non-salaried. So large proportion of non-salaried employees, there could be small businessmen, promoters of very small entities, sole proprietors, they're having small shops or establishments. So those are the kind of people who are there, who are taking these small loans. The borrowers are also not in the heart of metro cities. They would be either on the outskirts of metro cities or in the tier 2 or tier 3 cities. So that is another angle. The other thing that we see is the amount of loan to value, that these value of the property that these people borrow, that is lower than that of the conventional housing loans. In conventional housing loans, you could see loan to value ratios of say maybe around 80% or so on an average, whereas in this particular segment it is around 60% or so on an average. The other thing that is a market difference is the fact that declared or reported income of these borrowers, that may not be their real income. So they have income from sources, cash based income, which is not actually factored into a salary slip, which is in a conventional borrower, you have a salary slip, and that is what is looked at by housing finance companies while evaluating their credit profile. In this case, because whatever income proof they will have will not be a reflection of their total income, the housing finance companies will have to go beyond the reported income to figure out a more accurate estimate of what is their actual income, and that is called assessed income. Rather than documented income, here they look at assessed income. And once they look at that, and the key is to evaluate that in a more accurate fashion. How accurately can you evaluate the income of that borrower? If you can evaluate that very accurately, then you are actually in a very good place in order to evaluate the credit profile of that. So these are some of the differences between the borrowers.
All right. So given the lower share of customer who's salaried person, I'm sure, how do you expect credit costs to move? Clearly delinquencies are expected to move up in this space then.
Yes, we are expecting delinquencies to be higher in affordable housing vis-a-vis conventional housing loans, but these will be counterbalanced by the higher interest rates which these companies will charge these borrowers. So clearly we see that the interest rates which are charged on the housing loans affordable segment, that are much higher than in the traditional housing segment. So that will factor in a balance for the higher operating cost that these finance companies will be engendering, for one, for growth of their business, and number two, to have good processes in place to evaluate their customers and collect from them, and number three, to factor in the higher credit cost. There will be credit costs, higher credit cost, because the profile of the customers is, I would say, a little lower than that of the conventional housing loans, where the customers are more salaried, more documented income, and ability to assess them is easier than in the affordable housing segment. So essentially it's a risk return trade off. The risks are higher, but you are charging higher yields to them to balance that.
All right. Of course, many existing players in this space have seen capital infusions. There seems to be a lot of private equity interest there also. So just on a longer term basis, if we talk about the next 3 to 5 years, fair enough, there's going to be intense competition in this space, but would you believe there is enough room for everybody to participate and grow? And if you could share some numbers or estimates on the demand supply situation that you're having.
Yes. So today, as you rightly point out, there are a lot of private equity interest in housing finance companies, because this is a segment, if you look at the Indian economy, this is a segment which has been remarkably resilient. We have not seen too much of unpleasant impact on this, whatever be the nature of the economy, or if you look at some of the other sectors, they have suffered from NPAs, or they have suffered from defaults and so on. But in the housing finance space, we have had a reasonably steady growth. Profits have been coming in. Capital position of most players is good. And they seem to be knowing how to run the business, and the underlying demand is also there. There is a housing shortage in India. The government of India has a housing for all overall plan by 2022, and under the first scheme around 7 lakh new houses will be built, but even then that will still not cover the full shortage. So the basic necessities in India are roti, kapda and makan is one of that. So people need houses, and that demand will continue. We don't see a problem from the demand side. It is a fact of how much of the houses which are there, which will be built to meet that particular demand. Today, if you see, there are a large number of houses are built in 1 crore and above category. So there the demand is stagnating, there is muted demand. But if you see in this category, 15 lakhs or thereabouts, there will be demand, and there it is largely, it's a people are buying those houses to stay in them, and not from an investment perspective. Right. So they will be staying, and they because they are staying in that, there is a psychological attachment for repaying. So they don't want to be thrown out of those houses. Right. So they will repay. So we don't expect too much of a delinquency issue. Of course, the cash flows or the income streams of that borrower are under pressure. He may default, but that's a risk that we need to the HFCs have to take. But we believe that's inherently it's a safe asset class, and there will be a demand because of the housing shortage in India, and this segment will continue to grow. We believe that over the next 3 to 4 years, in the affordable housing segment, there will be a demand growth of around 40% CAGR, as against 17 to 18% on the overall housing finance industry.
Alright, so higher returns will make up for the higher risk as far as affordable housing financiers are concerned. That's the word coming from CRISIL's Krishnan Sitaraman. Thank you so much for joining us. It was a pleasure talking to you.
Thank you so much. Pleasure is mine.